So you just bought a call option and the underlying stock price is going up, but your contract for some reason is losing value. It could be that you don't have an understanding of option Greeks and how they work. Well, in this video, we're going to be discussing how option Greeks can make or break your contract. Hi guys, welcome back to my channel. If you're new here, my name is Mel, and today we're going to be discussing option Greeks. And this for me is really important because when I first started trading options, I had a very minimal understanding of option Greeks and how they pertain to the option contracts. And it wasn't until I really grasped the concept of option Greeks that I really started making money with options. So stay tuned, get out a pen, a notepad, your phone, your computer, whatever you use to take notes, and let's get into the video. All right, so what are the option Greeks? Option Greeks, simplified, is just the metrics that can affect the price of the option contract. Pretty simple, nothing too complicated. I have been in situations where I bought a call option. So in this case, I thought that the underlying stock was going to go up. And indeed, the stock did go up, stock price went up, but I started to lose money on my option contract. And so this is why you understanding the option Greeks can make or break your contract. So there are 5 main Greeks that you should be familiar with. I'm going to go over 4. I'm going to name all 5 to you, but I'm going to mainly go over 4 because the 4 that I am going to discuss is what most traders use when it comes to trying to really get an understanding of whether the option contract is a good deal or not. You have first the Delta, you have the Gamma, you have Theta, you have Vega, and then you also have Rho. And Rho, I'm not really going to discuss much in this video, but just know that Rho is a Greek when it comes to options. So some people put more importance on one Greek over another. I think they're all pretty important, but I will say I do have a favorite Greek myself. And in that case, I do prefer the Delta over a lot of the other Greeks. And so let's just start off with the Delta. I'm gonna break the Delta down to you first. All right, so when it comes to the Delta tells you 2 things about an option contract. The first thing the Delta tells you is the likelihood of your contract expiring in the money. So basically this just means that at expiration, you do have true intrinsic value. And then the second thing that the Delta tells you, which this is why I love the Delta, when you buy an option contract, whatever your Delta is, this is how much money you will make initially every time the stock price moves $1. And I say initially because there is more to it. There are things that affect the Delta down the road, but we'll get into that in just a second. What you do need to know is that when you're looking at an option chain, a call option will have a positive Delta, whereas a put option, they'll have a negative Delta. And that's just because the call option, whatever direction that the price of the stock is going, that's where your call option price is going. So when you buy a stock, you think that the price is going to go up. So of course, as the price goes up, you make money. On the other end of that, when you buy a put option, you're basically just saying that you'll make money when the price of the contract goes down. So as the price goes down, you make money. So that's why when you look at an option chain, the positive side, which is going to be the call side, you'll see that as the Delta, and then on the put side, the Delta will be negative. All right, so now what I want to do is I want to open up my Sim account and I want to show you an option chain so this could all make a little bit more sense to you. And if you missed my previous video on option trading, go back. I will link it down in the description box so you can get a real understanding of options, and this may make more sense if you do watch my previous video. All right, so I am on the option chain and I am at a September the 20th expiration, and this is Apple. We're looking at Apple. And I'm going to buy let's just say an at the money option contract, a call option. So we're making money when the price goes up with a call. So let's look at the call side first. So at 2:30 with the September the 20th expiration, you can go over and you can see right here that the Delta is 0.60. So when we're dealing with option contracts, remember that one contract is equivalent to 100 shares. So we do have to multiply this by 100. So if you did that, you would get $60. So this just basically means that if you were to buy an option contract and Apple's stock price is at $230, and you bought at the money at 230. When Apple's price moved up to $231, you will then make $60 on this contract. Okay. And so then let's go on the other side of this. And let's just say that you wanted to buy a put, and just say you think Apple's price is going to go down from here. So you want to buy a 230 put option. So if you go over, you see that it's negative, because you remember I told you that the put side is always going to have a negative number. So it is negative 0.40. And so this just basically means that if Apple's price does indeed go down to $229, you will make $40. Okay. And so you remember when I also told you the likelihood of your money, your stock expiring in the money, it's also telling you that. So you notice here, okay, so let's keep in mind, so as of today, so this is July 10th of 2024. If you look at the stock charts, if you look at Apple's stock chart, Apple's current price is at all-time highs as of today. So the market is telling you that the likelihood of your contract expiring in the money at 230. So this just basically means that Apple's stock price is going to be $230 or more. Okay. So the likelihood of that happening is 60%. So that's a good chance. If you look on the put side, though, the likelihood of it being less than $230 by September the 20th is 40%. So it's a less of a chance of that happening. And that's just because the market is telling you that, you know, the price of Apple stock has been on a tear. So that's why the put option delta is less. So and then let's get into the next option Greek that I want to discuss, and that is the gamma. So like the delta, so the gamma was something that I understood a little bit later on. The delta was actually, I think it's probably my favorite because it's what I understood first. But the gamma is important as well. You know, when I told you that when you buy the contract initially, that when the price moves up $1 with the delta, that's how much money you're making. Well, the gamma affects the price of the delta later on down the road. So the gamma, just say we have a gamma of 0.05. So remember, we have to multiply that by 100. Okay. So at 0.05, that is $5. So in that example with with Apple in the delta of Apple, the call option was 0.60 at 230 strike. So this just basically means that once Apple's price goes up $1, then the gamma is going to then start to change. So instead of you being at 0.60, the gamma at 0.05 is going to put you at 0.65 for the delta, if that makes sense. So let me show you on the option chain. Right, so I have my option chain pulled up again. I did have to go in and add gamma to my desktop version because I did not have it set. But as you can see, I'm still on the September 20th expiration for Apple, and at a 230 strike, we can see again that the delta is 0.60. But if you look over here, you see that the gamma is at 0.02. So this just basically means that every time Delta stock price goes up $1, that initially it's going to change to $2, right? So, okay. So for example, here at 230, so if the price goes up to 231, this will then change to 0.62. If it goes up to 232, it's going to be at 0.64 and so on, if that makes sense. And the same thing on the put side. So 0.40 is the delta. I'm sorry, that's the Vega. 0.40 was the delta, and then the 0.02 is the gamma. So this just basically tells you the rate of change of the delta. So that's why it's also important to understand the gamma, because it is closely tied to how the delta moves. All right, so the next Greek that I want to discuss is the theta. And the theta is very important, like super important when it comes to options. Theta is one of the ones that I did have an understanding on early. And this is the time component of an option contract. And so it's tied to the expiration. So this is why I mentioned in my previous option video that I do prefer to buy contracts with expirations that are at least 2 to 3 months out, because when it comes to theta, you do want to buy time. And just just remember that when a contract has 1 month or less to expiration, you'll notice that that contract may start to lose value at a higher rate. Like, it's been times where I'll buy a contract and I'll wake up in the morning and the stock price may have gone up some, and my contract for whatever reason is less, and it's probably because the theta is decaying or the time is decaying. So this is why I do prefer contracts that are in the money, and this is also why I do buy further out expiration dates. So you may be like, Mel, what's in the money, out the money, at the money? I will get into that in a later video, but I will tell you this. So when it comes to in the money contracts, so if you're buying a contract that is in the money, if you do understand in the money, if you're buying a contract that's in the money, you are said to really start to have true intrinsic value. So as your price of your option contract or your underlying stock starts to go up, you're good because you're starting to like really make money, because you're making money off the stock price going up and you're in the money. So it's true intrinsic value, because once that expiration is a week out or 2 weeks out, you'll start to notice that you don't have any time value. So this is why I do prefer to buy in the money contracts. Now, I will say I do buy out the money contracts, but when I buy out the money contracts, I buy them way out in the future. So I buy leap options, for example. And when I say leap options, it's just a contract that is way out in the future. So like 6 months to a year. Some people say a year or even 2 years. In this way, if you're buying time, you're buying a contract that's way out. If I am buying an out the money contract, I'm at least giving myself enough time for the stock to move in my favor and to be in the money. Okay. So I hope that makes sense. I do want to pull this up again on my option chain just so you can see the theta. All right, so I'm gonna show you on the option chain how theta starts to pick up. And so you can see right here it's a negative number, and that's because you're starting, it's decaying. It's going to decay over time. So as you can see, when I get closer and closer to my expiration, that decay is going to get higher and higher. So let's start here. If I am in December 18th of 2026, you can see that the theta is negative 0.03. So it's only losing $3. But let's just get here. So it goes up. And so let's go all the way. Let's do 36 days to expiration. Now you see it went from 0.03 to negative 0.11. And let's go to Wednesday expiration. Look at this. You see it's 0.53. So you see that theta decay is a lot higher the closer you get to expiration. And this is why I do prefer to buy in the money options, especially if you're going to get close to expiration, or if you're buying an option contract with the intentions on making money in like the next week or the next 2 weeks, because you don't want that theta to decay to eat you alive, because I promise you it will. And this is why some people will buy out of the money option contracts with an expiration of that coming up Friday, and then they're trying to figure out why they're losing money, and it's usually that the theta has just eaten your contract, has eaten your contract up. So that's why I prefer in the money option contracts. So the next and the last option Greek that I do want to discuss is the Vega. So the Vega tells you how much an option premium would change in response to a 1% change in implied volatility. And so implied volatility is the main thing that I do want to talk about when it comes to Vega. And when it comes to implied volatility, it's the market estimating the likely movement of an underlying stock. So this is why it's possible to have two different option contracts where the stock price is the same, but the option contract on one is more expensive. So one thing you do need to know about the Vega is you want to make sure you're careful with volatility when it comes to high volatility times. So like if the feds are about to announce an interest rate hike or a cut, or if a stock or if a company is about to report earnings, or if you have like a meme stock. So this is one thing that I do want to touch on. I heard so many people during the meme craze of GameStop and AMC that they were buying options on GameStop and they were losing all of their money, and the option contract the underlying stock maybe kind of stood still. It didn't drop, maybe went up a little bit, but their contract for some reason was losing money. And this is because of implied volatility. So implied volatility, it is basically the market telling you where the stock price is likely going to be, or how much the stock price is gonna move within the next year. So it could be, let's just say if it's 50%. If you open up an option chain and you see 50% implied volatility, it's just basically saying this stock is expected to move 50% plus or minus. So it can go up or it can go down, but it's just telling you that it's expected to move this much. So with GameStop, it was crazy IV. They call it IV, implied volatility. The IV on GameStop was crazy, and people were wondering why they were losing money. Well, if you bought GameStop when everybody was pumping the stock and the option contract maybe was sitting there, you thought that you were going to continue to make money. Well, as soon as that volatility left the stock, like recently, Roaring Kitty came back and he got on Twitter, or X now, and he talked about GameStop, and everybody started getting back into the stock again. Well, as soon as he left, it kind of just went ghost town again. And what happened was a lot of people bought option contracts with that high implied volatility. And when everybody left, the volatility just got snatched out of the contract, and people were losing money on the option contracts. So be very careful when it comes to trading option contracts around high interest times. Okay, so that's just what I do want to say about implied volatility. All right, guys, thank you guys for watching. I hope you guys learned something when it came to option Greeks. If you did, please like, subscribe, comment, share. Let me know what topics you do want me to talk about in the future. Somebody did ask me recently about crypto. I do not trade crypto. I'm sorry, guys. I don't trade crypto. I don't trade futures. I do only trade equities, and by equities I just mean stocks. So I do trade stocks and I trade stock options, but that's it. That's what I'm boxed into. Okay, not saying I won't. Maybe I will in the future, but I do not trade anything else at this time. But once again, thank you guys for watching. I will see you guys in the next video.